Is the Tata AIA Shubh Muhurat plan truly a lucky start to your financial journey or just symbolic branding with little substance? Let us find out through an in-depth analysis in this video. Hi there, welcome back to holisticinvestment.in, where we help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand a few basic details about it. So, this policy is a combination of Tata AIA Life Insurance Fortune Guarantee Secure Plus Plan and Tata AIA Life Insurance Smart Fortune Plus Plan. So, both of these policies have been reviewed in detail in our YouTube channel previously. So, if you want to watch those videos, understand more about those policies, you can definitely find the link in the description and watch it. So now let us take a look at the key features of the policy. So you get to receive structured payouts that can be aligned with key life milestones such as your child's wedding. You have the opportunity to grow your wealth over the long-term period through equity market participation. You also get to enjoy comprehensive life insurance coverage throughout the policy term to secure your family's future. The premiums you pay contribute towards a lump sum benefit at maturity or in case of unforeseen events. And opting for the MWPA, which is the Married Women's Property Act, ensures that the policy benefits are exclusively protected for your wife and children, shielding them from creditors. So this benefit protect rider waives off future premiums in case of unforeseen hardships, keeping your plan on track, and you get to avail tax benefits on both premium payments and payouts as per the current tax regulations. So these are some of the key features of the policy, and if you want to know more about aspects of this policy in detail, you can refer to the policy brochure as well. Now, as we have a basic understanding about this policy, let us move on to the analysis part of the video, where we are going to go through the disadvantages of combining investment components with life insurance. So first of all, don't fall for the insurance investment bundle trap. Many insurance companies offer bundle products that combine life insurance with investments like endowment plans and ULIPs. While they may seem like a two-in-one deal, the reality is far from ideal. And here's why you should stay cautious. First of all, higher premiums, which means lower coverage. Bundle plans come with high premiums. For example, if you pay 50,000 per rupees per year in a ULIP or endowment policy, only a small portion goes towards actual life cover. The rest is invested. So in contrast, a pure term life insurance policy gives you substantial coverage for just 10,000 to 15,000 rupees annually, freeing up the rest for better investment options. And number two, high charges in ULIPs. ULIPs comes with multiple hidden charges like premium allocation charges, policy administration charges, fund management charges, mortality charges. After deducting all of these, only a fraction of your premium will actually get invested in the market, and these charges will erode your returns, especially in the initial years. Number three, poor returns from endowment and ULIPs. Endowment plans mostly invest in debt-like instruments and offer returns of 4 to 6% annually, barely beating inflation. ULIPs may offer slightly better returns, but after charges, you would likely to less earn than a mutual fund SIP. And number four, it will not help you achieve financial goals, because if you're investing 50,000 rupees annually in a bundle plan, expecting to build wealth or achieve goals like buying a house, funding your child's education, or planning for retirement, you're likely to fall short. These products neither offer adequate insurance nor sufficient investment growth. So what is the final takeaway? Is investing in this policy worth it or not? From a personal finance perspective, we recommend the following foundation: a pure term insurance plan with adequate sum assured, a separate health insurance policy, preferably a family floater, and an emergency fund covering 6 to 12 months worth of your expenses, including your EMIs. These three pillars create a safety net that allows you to invest with confidence. Once you have this foundation, assess your risk tolerance, life goals, and investment horizon, and then build a diversified investment portfolio accordingly. Avoid bundled investment and insurance products that dilute both the objectives, and it also has a high agent commission.
You can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.